again, in the same example, let's say you're paying 10% down payment, 30% over, let's say, 5 years to pay. So your total equity at the end of that 5-year term is already 40%, and then you have a balance of 60%. That 60%, for example, you took a loan from the bank, and you were approved, you get a mortgage, right? Before the bank approves you or gives the that loan to you, they would require you to get an MRI. Hi guys, welcome back to the Property King. So for today's episode, we're going to discuss the two types of term insurances when investing in real estate. What are the two types of real estate insurances that you need to know about before you invest in property? So we have the credit life insurance and the mortgage redemption insurance. Okay. So on one hand, that's CLI. On the other hand, that's MRI. Okay, so let's dive in deeper the difference between the two. So when you're investing in property, let's say you're investing in a pre-selling condo, in a primary market through a developer, you usually have the no down payment schemes, or let's say you put up a 10% down payment and then installment for another 10%, 20%, whatever it is, over an X amount of years, right? So you're still paying in-house to the developer, and usually it's at the rate of 0% interest. During that period that you're paying to the developer, okay, you can actually get an insurance. Okay, it's what you call the credit life insurance. Now, this insurance protects you in the event that something happens to you. Let's say, for some reason, fortunately, you pass away, okay, and then the insurance, that credit life insurance, will take care of the remainder of your balance. Okay, so they'll be the one to pay the developer the whole amount that it's still payable when it comes to your total contract price. Okay, so that's CLI for you. In that way, you don't have to worry about your heirs, your relatives having to put up with the cash to be able to pay that huge balance. Because in most cases, for some developers, okay, what they do, if let's say the initial buyer, where let's say you're the buyer, right, and then you pass away, and then what will happen is the remainder of the balance will become due and demandable. Okay, so you will have to negotiate. Let's say you still have supposedly 3 years to pay left in your payment term, but then something happens to you, the whole amount becomes due and demandable right away because the primary buyer is already passed. Okay, so you would have to negotiate with the developer in order to extend the payment term. You would have to go through estate taxes. You have to go to court proceedings if there's no last will and testament. So it's a very huge hassle. Okay, so having that CLI will give you that peace of mind that if something do happens to you, knock on wood, right, at least your heirs don't have to worry about paying the remainder of your real estate property. The real estate balance. Okay, so you'll just have to think about the estate tax. Okay, so on the other hand, what is MRI? MRI, on the other hand, is what you call the mortgage redemption insurance that is usually required by the banks before they grant you a loan. Okay, so again, in the same example, let's say you're paying 10% down payment, 30% over, let's say, 5 years to pay. So your total equity at the end of that 5-year term is already 40%, and then you have a balance of 60%. That 60%, for example, you took a loan from the bank, you were approved, you get a mortgage, right? Before the bank approves you or gives the loan to you, they would require you to get an MRI. Okay, so that is the insurance that will cover the balance in the event that something again happens to you while you're paying the monthly amortization through the bank already. Okay, so that's the difference. So in a sense, it's actually the same concept. It's actually a protection for you when you're in the process of paying the monthly amortizations, either through the developer, usually at 0 interest, or through the bank, this time with interest. But the difference between the two is that the general practice right now for most developers is that they don't require investors or buyers to take a CLI or a credit life insurance, as opposed to banks. Before they give you the loan, they would require you to get an MRI. So why does the bank require MRI as opposed to developers not requiring the CLI? Okay. So banks are in the business of lending money, right? So they earn money through, giving out loans and charging interest for that. So they need to be very liquid so that they have a lot of funds to pay for these particular properties for the loans, right? So they want to be protected. So if something happens to you, they don't want the hassle of, going through auctioning your property, right? Going through all these estate proceedings, right? When you have the MRI, that protects them in a way, right? In terms of their investment with the property that you took a loan from, right? Okay, so that's particularly the reason why they require the MRI, because they're in the business of lending out money, and they need the liquidity. They need that fast liquidity so that they'll be able to turn it over again, for another investment, which is another loan. So another question that may come up to your mind is, what if I have my own, insurance, let's say with all of these other insurance companies, right? Let's say you have a VUL with a particular insurance company. There's a lot of companies out there right now giving out insurances with a mix of investments, right? Either in the stock market or bonds, fixed income instruments. They're offering this, right? So what if you have insurance for that? Can you use that insurance to cover, or to protect you in your monthly amortization with the bank or with the developer? In a sense, yes, but for these insurances, your beneficiary is usually your heir, right? And what happens is that if something happens to you, the proceeds from that insurance will go to your heir, and it's up to your heir to pay the estate tax on that property, okay, that you purchase, and also pay for the balance. Okay, the main advantage of having the CLI or the MRI is that the direct beneficiary of these particular insurances is to the developer or to the bank where you took the loan from. You don't have to think about or worry about, okay, are my heirs going to pay for the balance, or are they going to use it for themselves, the money, use it for other things, or they're going to pay the estate tax, okay? So that in a way gives you that peace of mind, in a sense that the proceeds of that particular insurance will go for the specific purpose, which is the purchase of your property. So I hope this sheds light on your questions about insurances, term insurances, when it comes to investing in real estate. So if you have any more questions, comments, reactions, put it in the comment sections down below. Also, if you're new to the channel, please press the subscribe button and hit that bell icon so you're notified each time we have a new episode such as this. Again, this is RK from Property King. Thank you so much for listening. And remember, let's all grow wealthy together. Goodbye.